The following is a presentation of TFNN. Now, TFNN opens the door to the future. Larry Pesavento, systems analyst, is your tour guide into the market futures. Want to see into the future? Well, climb aboard Larry's time machine and come with us. Larry takes your phone calls now, toll free at 1-877-927-6648. This is the Futures Hour. Here's your host, Larry Pesavento.
Okay, folks, good afternoon. I started the TFNN show by posting a chart of DBA, which is the ETF for the commodities. What's interesting is this hit the 618 about 7 or 8 days ago, had a minor rally, and today we gapped down below the 61% retracement. That sort of surprised me because we're having a tiny bit of a pullback in silver and gold, and also in corn and beans and wheat. We are expecting those because we hit all those nice toppers, those nice patterns that we hit, and that was the interesting thing to look at. Now, I also posted the chart for copper into the room because copper is very instrumental in the economy. It's all electrical and building stuff, and it's really it hasn't even taken out the highs of late December. I don't know why it's lagging. That doesn't mean it can't catch up very quickly, but we've had these lower tops ever since February of last year. So it's still in a bear market, but it could come out of there without too much trouble. What's troubling about the DBA is that it's got quite a few things in it as far as things for commodities. It's got the soybeans and corn and the usual things, and why it's not rallying more is a mystery to me. Now, I know ETFs are very difficult because they don't trade overnight like the other vehicles do, and so it makes it interesting to see how some of these things are going to play out. But we are right at the 61% retracement in this DBA, and we gap down. Whether we're going to stay down here or not. All I look at this as a possible a warning shot across the bow, because I know the stocks are going crazy to the upside, but it's going to be difficult for them to go straight up. Well, they've already gone straight up, but to continue going straight up without the commodities would be very, very unusual, because in order to to sell things, you have to buy commodities in order to to build the products and stuff that you have. So we'll look at that down the road a little bit. Someone Skyped me right before the show and asked me about where they would buy Apple. And Apple's had a heck of a move down today. I guess the earnings were bad. I'll put the chart in. Apple is now at the 61% retracement of last June's low. We've given up quite a bit, and so it's right at the 61% retracement. So the old theory is if it was a good buy at 700, 600, and 500, well, it's setting at the 61% retracement there, and it has several ABCD patterns. I think the lower pattern is down around 394, but if you wanted to take a gamble, let's call that a calculated risk, you could buy a call. You could buy probably a $500 call on Apple, and it wouldn't be too much at all. I had an interesting thing happened on Bloomberg today, because there was an analyst that came on that had been promoting Apple for quite some time, and he came on today and he reduced his target from $1,100 a share down to $888 a share on Apple. Now, I don't mind being wrong, because I'm wrong a lot, but I'm the first one to admit when I'm wrong. But, I would like to know who that guy reported to his boss to say, look, I'm reducing my target on Apple from 1,100 to 888, and the stock's trading, at 460. I wonder what was going through the boss's mind. I wouldn't be able to do that if I were the analyst on that. I would just say, hey, look, I really screwed this one up. Let's look at something else. But this is how Wall Street works. So evidently we have a target of 888 now on Apple, which would be up another 400 points. So it's got to double in price pretty much. But if you make a mistake in these markets, folks, take the responsibility and stand aside and go on to the next one. I'm in a trade of the year that's not working. I'm halfway to the stop. It still might not work. I don't know, but at least if it gets there, I bite the bullet, and take the medicine and move on. This is a game of accepting your own responsibility for these things. So you want to be able to take that responsibility. Now, the gentleman that was on yesterday, we talked about the TFF and also the IWM, about the gaps that were in there. I made a comment on one of the shows that I had not seen any unfulfilled gaps, and we were referring to the TFF. I've never traded the Russell 2000, but I did do a daily. I did do a daily chart on this, and the chart. I went back and I looked at this time period in July of 2009 where there was a gap. Well, there was a gap on the IWM, but on the TFF there was not a gap. I went back and I looked, and I'll put this in here to show you because the gentleman, believe his name was Bob, was correct about this because the IWM did leave a big gap, but the TFF didn't leave a gap, and I think I know the reason for that is that the way that it's reported is they use the previous day's high or the high or the close as a starting trade. Now, they've changed that since that time, but most gaps are filled. I'll stand by that, and we have a whole bunch of gaps in the a lot of these indices, and we're going straight up, and we have a full moon tomorrow. That'll be on the 25th on Friday, and believe me, it's going to be really difficult for the market to be down on Friday. It might be down a little bit, but for it to be a reversal day would be very unusual because the people that are in the hedge fund business and in the mutual fund business, they don't get their signals on Friday. They do their work over the weekend, and then they come in, and then early in the week, Monday, Tuesday, Wednesday, that's when they're actually doing their, doing their trades. So that's what I see for the stock market. We're in this position. It's out against us right now. We still have to stay with it. We'll have to wait and see. The next one we want to cover, I want to try to cover these in the method of commodities, what we use each day. And I wanted to go into the cattle market because we talked about that one quite a while ago, and it made a big butterfly pattern, way up in mid-December, and it's been straight down into the 61% retracement, down at that 130 level, so it dropped about 8 cents. So this is one of the reasons why the DBA could be coming down. But the cattle has been coming down before this, so there's some other things in the DBA that are pulling it down, and that makes us wonder, what is causing this this movement to make it look like, it's not doing nearly as well as it should be doing. Now, the one that we've really watched closely and we want to buy just as soon as we get the signal is corn. And for some reason, I cannot find my corn chart on here. All right, I'm gonna do the here. I'll have to get it up here. Just give me a second. Well, let me do wheat here first, because then I can do corn after the break comes in, because we have the same situation, occurring in the wheat that we've had in the corn and beans and everything else too. So, oh boy. All of my frustrations in this business, folks, come from computers. Today it was email. I got stuck in an email web where everything that I sent out went out 6 times, and then it looked like it was not sent out. And so I really don't particularly care for computers, but unfortunately that's what we have to use. Now the wheat market, as we mentioned several times, has rallied less than the beans or the corn, either one of those, which is that's our third biggest crop. We have corn first, then we have wheat, and then soybeans, and then we have wheat as our crops. But by far the biggest one is the corn crop, and that's the one that looks the most bullish from the standpoint of these numbers that we've been looking at. And we've had a big move in the corn coming off of that report that we looked at. And all we're going to do now is we're going to take a look to see where the retracement should come in at this level in the corn, because let me try to get this straightened out a little bit here, and I'll move it over just a little bit. And you have to appreciate trying to do a radio show and doing technical things at the same time is a little difficult. So we'll have to just give it a little bit of time. Now, this is a real interesting chart here on the corn. I'm going to put it up here for a second because what Steve was talking about, what Steve Rhodes was talking about on his show was really important here. If you follow candlesticks, because this is a real interesting situation where you have a market that goes up and stops at these Fibonacci levels that we look at, 618 and 786, and how you can use some of these candlestick patterns in order to try to come in and buy them at a cheap price or at the best get in a good entry. If you'll take a look at this in early December when we made a 786 retracement in corn, you'll notice that there were dojis up there at the $6 per bushel level. There were 4 of them. So for 4 days, the market could not exceed past the 786 retracement. Well, if you go to the right and see what just happened in just a week or so ago when we were talking about it, we had the same situation where we had 4 dojis at the 618 retracement, and the market was going down because we had lower tops. Now, we had come off the big bottom where the crop report was, and we had a tremendous rally into that 61% retracement. It was, well over $3,000 a contract. And now what we're looking for is we're looking for a pullback in corn to the 382 retracement that will come in around the 60. Let me go to a smaller time frame here so we can see it just a little bit easier. And this will show the retracement that we looked at for the crop report, where it came exactly at the 61% retracement. And now what we'd like to do is we want to see the next 382 retracement to come in, and it's very close. We missed it by just a little bit today. We were looking to be at around 713, and it came in at 714, the 382 retracement. So whether we missed it by a penny or not, we'll have to wait and see. But corn still has a very, very bullish picture. Longer term, on the dailies, on the weeklies, on the monthlies, and on the shorter term, all of that still looks good. Wheat doesn't look nearly as well. Soybeans look okay. We'll take a look at the soybeans here. After the break, we'll take a look at the soybeans. But I wanted to mention one other thing about the Paul Tudor Jones tape that someone asked me about. The real key to that tape and why it was so interesting was the fact that the way that Paul Tudor Jones handles risk. He always talks about lose your opinion instead of your money, and that's very, very important. This morning, when they announced last night when they announced the Apple earnings, and I saw the drop down in the S&P only down about 4 or 5 points, and Apple down about 50 points, I said to myself and one of my other friends, I said, boy, if the S&P can only be down 4 or 5 points with Apple being down 50 points, if Apple starts to rally, look out, stocks could really move. Okay, we've got to take a little break here, 877-927-6648. Right.
Tom O'Brien's weekly newsletter, The Gold Report, has helped subscribers for over 10 years navigate the high-risk world of exploring and producing gold companies. And now's a great time to sign up for a free month-long trial to see the kind of insight that Tom delivers for his subscribers on a weekly basis. Every Monday, Tom O'Brien issues a quick update on the metal market, giving you his take on the HUI, XAU, GLD, dollar, bonds, and much more. Tom follows Monday's update with a full gold report, which is delivered to subscribers Tuesday afternoon with detailed coverage of 24 separate gold or metal stocks, as well as another 10 to 15 stocks that he lets you know are on his potential watch list. Get your month-long free trial to the Gold Report today by visiting the front page of TFNN.com. Don't spend another year navigating the metal markets on your own. Act early in 2013 and make the most of your gold and metal market investments. You've always taken the long view when it comes to investing, but what if there's an opportunity right under your nose? What if you could be more responsive to market trends to seek to boost your portfolio performance right now while seeking to reduce your overall risk? At Direction Funds, we connect investors with alternative strategies that seek to maximize their returns. Smart investors deserve smart alternatives. Find yours at directionfunds.com. An investor should consider the investment objectives, risk charges, and expenses of Direction Funds carefully before investing. The prospectus and summary prospectus contain this and other information about Direction Funds. To obtain a prospectus or summary prospectus, please contact the Direction Funds at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. Investing in index funds may be more volatile than investing in broadly diversified funds. Distributed by Rafferty Capital Markets, LLC. TFNN is proud to partner with Great Panther Silver for another exciting silver coin giveaway. The Great Panther Silver Super Silver Giveaway begins the week of January 28th and we'll be choosing 47 lucky winners. It's free to enter with absolutely no strings attached. Just visit the front page of TFNN.com today to fill out your entry form. Every hour that we're on the air, 9 a.m. to 6 p.m. the week of January 28th, we'll be randomly choosing one lucky winner that will win a silver coin or bar from Great Panther Silver and TFNN. And the final hour of the week, Friday, February 1st, we'll choose 3 lucky winners. That's 47 winners in just 1 week with over $1,000 in silver given away to our loyal listeners. Register today by visiting the front page of TFNN.com. And for more information on Great Panther Silver, you can click on their banner on the front page of TFNN.com or check them out on the NYSE Amex symbol GPL or on the Toronto Stock Exchange symbol GPR.
What type of investor are you? Conservative, moderate, or aggressive? No matter your investor personality, your overall portfolio should reflect your financial goals, time horizon, and your risk tolerance. Help ensure your portfolio is appropriately invested with an asset allocation plan from Morgan Stanley Wealth Management. Simply picking the right stocks is not enough. Research has shown that choosing the right proportions of stocks, bonds, and cash is essential to the success of your long-term investments. Morgan Stanley believes a carefully selected portfolio can lower volatility and increase investment return potential. Find out about what an asset allocation and a Morgan Stanley Wealth Management financial advisor can do for you. Call Angela O'Brien, First Vice President and Financial Planner of the Clearwater, Florida branch at 727-441-6108 today to discuss your personal financial needs. Asset allocation does not assure a profit or protect against loss in declining financial markets. Investments and services are offered through Morgan Stanley Wealth Management, LLC. Member SIPC.
This segment is brought to you by Great Panther Silver. For more information, just click the Great Panther Silver banner on the front page of TFNN.com. Now, back to the Futures Hour.
Okay, we're back, folks, and while we were on a break, we had a question from Mitch in Boston, and he was asking if I still thought that the Apple would go to the 390, which is the big ABCD pattern that we have, for a long time, what we've been looking at it, and that's what it looks like. We've gapped down. We're at a major 61% retracement, and the comment that I made was, if the stock market can't go down, with Apple being down $50 a share, the chances are, that it's not going to go down. On the other alternative, if the stock market should start to weaken from here, and that cycle that we're looking at does kick in, then Apple could easily make, the 390, the 394 level. The question that was posed is, if you buy Apple here, it's very difficult to hold it overnight. We talked about this yesterday on the show because of the earnings coming out. They're usually positive. It was a crapshoot yesterday, either long or short. And it happened to be the trend was to the downside, so it continued to go down. And now we've left another gap, and we're right at the 61%. In fact, we're trading a couple dollars below the 61% retracement at $4.62 a share. So technically, looking at this like we would any commodity or Forex or anything else, is that if you're going to do something here and you wanted to be a buyer of Apple and you believe that gaps are filled, and we've got a gap at around the 490 level, look at an April 490 call. It's probably not going to cost very much. It would probably be about $8 or $9 would be my guess. So that would be your total stop on this. That would be much like if you wanted to go long yesterday, which I don't see why anybody would have. But if you wanted to go long into these reports, if you do it by a call, at least you quantify, what your risk is. And that's the whole thing of trading. You want to quantify what's the risk. It's not how much you make on a trade. It's how much you risk. So someone asked me a question this morning, real early this morning, when I was in the room, they asked me, how is my mental spirits today, with the stocks going up and, me being short from the 480 level. And I said, the same as before, but I said, this is nothing, like what happened in March of 2000. I was very bearish during February and March of 2000, and I must have tried probably a half a dozen times on different patterns to, get short the market, and I kept, getting stopped out, and the losses weren't big, but they were, I was getting stopped out. I had some positions in other things that were doing okay, but in the stock indices, it was not working okay. But I kept nibbling away at it, and then finally, when the big turn did come in March, it started on March 24th of 2000. The Nasdaq dropped about 85%. In a matter of a couple of years, and believe me, it was easy on the straight down. Anytime the market rallied, you just sold it, and that was it. The question that someone asked me is Apple, in big trouble? I don't know if Apple's in big trouble or not. All I know is the stock is in big trouble. There's something inside that company that somebody knows, because even if they try to bring out good news, nothing happens. They raised the dividend last night to be yielding 2.5%, which is like a 30-year bond. And, of course, the 30-year bond didn't drop 10% today like, Apple did. So you have to be careful with this. So the only way you can protect yourself, trading these $400 and $500 and $600 stocks is to pick a spot and, to buy a call, and that will have to be what your risk will be, because unless you're willing to take a 10% risk in something, which, frankly, I don't think people need to do, then you have to, reassess how much you're going to risk on these things. So that's way too much to risk. So by buying a call, it gives you some time to work with it, and that's the best way to do it. It's the same thing as when it was up around the 680, 690 level. We were suggesting, if you're going to do something, look at a call or a put, because that way you have some time to work with it, and if it does turn out the right way, it will work. So that's all it is. You don't do puts and calls very often because, in general, they don't work too often. But going back to Mitch's question in Boston, yes, I still believe that we're going to have a shot at that 390 but remember, we were $100 away from that just a few days ago. Now we're only $66 away. One more day like today, and we would be at the target. And the date we were looking at, I believe, where time and price comes together on January the 28th, and that'll be next Monday. And so we'll have to see what happens at that point. We'll see if that's going to be the case. But frankly, if Apple does turn from here and start back up, it's had some support at that fib number of 462 a share. So we'll see. We've got to take a break here. 877-927-6648.
Just recently, on December 28th, Market Insight subscribers were advised to go along the QQQ, the NASDAQ 100 ETF, on December 28th at $63.91, and only 2 trading days later, after a huge jump in the markets, Market Insight subscribers were advised to sell the QQQ at $66.64 for a $2.73 or 4.27% profit to start off 2013. At the same time, Tom O'Brien had advised his clients looking for a more leveraged trade that they could have initiated a position in the QLD, the ProShares Ultra QQQ ETF, and over the same 2 trading days, Market Insight subscribers were able to lock in a $4.48 profit or an 8.47% gain in just 1 trade. Get your 2-week free trial to Market Insights today by visiting the front page of TFNN.com. Cancel at any time during your free trial and pay nothing. Don't miss out on the next great trading opportunity in 2013. Act today. In quiet markets, investors search for new trading opportunities. We'd like to introduce you to a new product that provides opportunities even in flat markets. Nadex, the North American Derivatives Exchange, is a new and innovative Chicago-based exchange registered with the Commodity Futures Trading Commission, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their trading platform. Nadex never charges a fee to use their platform, which even includes real-time charts and full customization capability. Nadex's unique short-term binary options allow traders and investors to capitalize on strategies even when the underlying markets are quiet. Nadex's innovation has allowed them to come up with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com, or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors.
Recently, Basil Chapman has had some outstanding trades in his newsletter, The Opening Call. Each morning by 9 a.m., Basil uploads his newsletter to the TFNN servers so that his subscribers can access his expert trading advice. Basil gives his take on the direction of key indices and updates any active trades that his subscribers are currently in. Just recently, Basil subscribers closed out a short position in Chipotle Mexican Grill, CMG, for more than an $86 profit per share, over a 20% gain in just one position. If you'd like to try out Basil Chapman's newsletter, The Opening Call, then visit the front page of TFNN.com and click Trading Newsletters. There you'll find Basil's newsletter, The Opening Call, where you can request a free sample copy. Also, don't miss Basil's program, The Tiger Technicians Hour, Monday through Friday, 11 a.m. Eastern, on TFNN.
Tom O'Brien's weekly newsletter, The Gold Report, has helped subscribers for over 10 years navigate the high-risk world of exploring and producing gold companies. And now's a great time to sign up for a free month-long trial to see the kind of insight that Tom delivers for his subscribers on a weekly basis. Every Monday, Tom O'Brien issues a quick update on the metal market, giving you his take on the HUI, XAU, GLD, dollar, bonds, and much more. Tom follows Monday's update with a full gold report, which is delivered to subscribers Tuesday afternoon with detailed coverage of 24 separate gold or metal stocks, as well as another 10 to 15 stocks that he lets you know are on his potential watch list. Get your month-long free trial to the Gold Report today by visiting the front page of TFNN.com. Don't spend another year navigating the metal markets on your own. Act early in 2013 and make the most of your gold and metal market investments.
This segment is brought to you by Crocodile Gold. For more information, just click the Crocodile Gold banner on the front page of TFNN.com. Now, back to the Futures Hour.
Okay, we're back, folks, and we're going to talk a little bit about soybeans. The daily chart is up there going back for the past year, and as you can see, we hit the exact 61% retracement on the yearly basis at the $13.54 per bushel level, and then we had a rally of a little over $5,000 a bushel that came in exactly at the 61% retracement, and right now, we talked about that just a few days ago, that we were expecting a correction, and we want to see what this correction is going to be. We'll have to wait into Monday or Tuesday, because you usually get a 3 to 5 day correction after you've had an 8-day run-up. So we're waiting to see, what happens, with that on a longer, on the shorter-term basis. But on the longer-term basis, we talked about this, over the past several weeks. The soybeans have made a huge move going back. They doubled in price from $8 to $18 a bushel, and now we've pulled back to a 61% retracement, as we showed on the daily chart. We've had the good rally back. We have some strong cycle formations that have formed there. There are 28 and 60-week cycles that have held up relatively well, and we're just beginning that cycle. So we want to look for a place to be long as we come into these cycle lows that we have. But we must wait at least a few days for both, for wheat and corn to buy those, because we need them to get down to a point that is relatively low risk. They've had the nice rally up, good profit taking place at the 618 of both of these, and now you want to buy it on the retracement back. The question that was posed about the Apple call, I have to keep going back to that stock, but they have questions about it. So the Apple, I talked about a 490 call for around $8 to $9. Well, actually, the call is selling for $12 for the 490 call. I think that is way too expensive, and so I would just stand aside. Now, when we get down to if we get down to the 394 level, which is the large ABCD, and it's the very, very long-term 61% retracement going back several years, then I think that's the place where we'll be looking to be ready to get long Apple. By that time, all of the longs will be, totally, disintegrated, and if they aren't already, then you'll be able to see it. If there's one lesson to learn here, folks, and it doesn't make any difference whether it's stocks or commodities, you can't believe that what they tell you on Wall Street on the fundamental stuff. At least on the technical stuff, you can see it on the chart. They can lie to you. They can give you misinformation. They can hide information from you, but they can't hide from you. If there's more buyers, prices are going up. If there's more sellers, prices are going down. If you look at the chart of Apple, it's been going down for 6 or 8 weeks. I mean, with really great news. You remember at the top, they had all kinds of free news. People standing in line, and they were selling the iPhones or whatever those things they are. They sell on eBay for 2 and 3 times the price. So that's the emotionalism. That goes back to the book by Donald Mackey, The Popular Delusion and the Madness of Crowds. If you've never read that book from the 19th century, you really should, because nothing ever changes. And this is why politics works the way that it does. People are perceived for who they are, not what they are, and that's the same thing with markets. That's why you've got to be able to determine, where you stand, and that's what technical analysis will try to do most of the time. We'll give you that spot, to take a look at that. We need to look at a couple of things here because the time goes very quickly. We need to look at the bond market. We've had a really nice move in bonds over the past few days, and now we're having the correction come in. We were expecting it to come in at the 61% retracement at the 146.20 level, and we got to 146.14. We missed it by just a little bit, and now we're in the midst of a correction. We've had 3 higher bottoms now in the Treasury bonds, so there's still a potential for this rally, to get up to the 150 level. Now, we have to play the devil's advocate here because I'm incredibly bearish Treasury bonds long term, and if we go below the 143 level after what just happened, that will be equivalent to what happened in Apple when it went below 600 the first time. So we've got to watch the movement in Treasury bonds. This might be one of the times where we have to get in to the market on weakness. If it breaks a point, look to put a stop in, and that's what we would be watching. But right now, the bonds have came off the bottom. They stopped exactly where they should have. Took the exact number of days up in the AB leg that it did in the CD leg, which was good. And we haven't fallen out of bed with the stock market going up, which is also surprising. You'd think there would be a real runaway from quality now, but in fact that's not happening. They're still looking at the Treasury bonds. So the Treasury bonds below that 143 level, then that's what we really have to be looking at. The other interesting thing is that the people are all talking again about the big boom that's going on in China, that nothing ever really happened, that the boom has always been going on, even when the stock market was going straight down. After we had that butterfly pattern form in the Chinese market about 5 or 6 weeks ago, we've now rallied up to the 61% retracement of the high of 2010. So we've completed a big rally at a 61% retracement in both the Hang Seng and in the stock market for China. So those patterns are being completed, as we speak right now. But that's all related to the economy. And believe me, these commodities that we're looking at better start going up, because you're not going to have a boom in any stock market if you don't have a boom in the commodity markets, because they make these products with the things that are in the commodity markets, And if they don't buy these things, these things are not going to go up. And believe me, in the stock, remember, folks, the stock market is not the economy. It's very important that you understand that. The first economist that really talked about that was Milton Friedman back in the 60s. And he was one of the people that was instrumental in starting Commodity Corporation. And the commodity, the stock market is a perception of where things are going to be and how they raise capital. It is not the economy. So I know they use it as a gauge, but as a matter of fact, it's really not what the economy is. The economy is the GDP, and the borrowing and all that other stuff that goes along with it. But the stock market, is for speculation and investment, which is a big thing. Now we need to look at the U.S. dollar, because here's another one that is really perplexing to me. By the way, that was my opinion of what I think the economy is about, but that's neither here nor there. We've had a pretty wild activity in the different markets, the VIX and all these things, but the dollar index over the past couple of weeks has done very little. It's gone between 79 and 80.5. It's still in this really tight trading range. If we break out of this range either way, I think that will really be a significant. If we break above 8,100 in the dollar index on the upside, and if we break below 7,800 on the downside, then I think that would also be significant. But we're a long ways from that. We're right in the middle of those areas. We bounced off these 786 level, and then we just rallied up the last few days to stop at the 61, and that relates to the 134 level in the euro. So those are the ones that we're keeping a close eye on. But not much is going to happen with the U.S. dollar unless we get this. Unless we get this. I've lost track. I better change my thing. Let me go to something that I can understand. I think I don't know if I did the gold market or not. I don't think I did. I better bring it up here because it's important here. The gold market's had a really nice run here for the last. I did do the gold. I'm sorry. I want to do it a little bit shorter term to show you where the real strong support in gold is. It comes in at the 655 level. That's the 61% retracement of the big move. We don't have a Gartley pattern there at all, but it's still a nice retracement at the 1655 level. The number in silver, we've had a little correction in silver of around 80 or 90 cents, and that silver should also have support around the 3050 level. So the commodities are coming down, but that's just the fact that we've had a really nice rally since January 4th when we bottomed at 1628 in the gold and 2940 in the silver. So we are completing those. We're completing those rallies without too much trouble. I need to show you the Japanese yen because I believe that this is the real sleeper. I've been saying that for a very long time, and we've had a tremendous move up above the 79 level that we talked about as almost every day as it goes up. And we had for the first time, I'm going to go to a 30-minute chart to show you that we did have our first correction here. Just a second. Oh, dear. There we go. Hold on a second here. There we go. And this is what we talked about a few days ago. Wow, that was yesterday. Holy cow, I forgot about that. We had a 61% retracement in the Japanese yen, and it came in at the 88 level, and we've since rallied, $2,000, just about straight up from that level, and that means that the yen could weaken to the dollar again. This could be instrumental in what's going on, with our stock market, that they're going to be using, cheap dollars, to buy stocks again, much like they did with that carry trade in the end. Maybe that will reverse. I don't know. All I know is that all of the things, they're not working together like they usually do. In other words, when stocks go up, they should be followed by some of the commodities, especially the ones like copper and things like that. And we also, if you look at the index for the Dry Baltic Index, I mean, that Dry Baltic Index is near the lows of 2009. Now, the people that talk about this index, that know a lot more about it than I do, say that the reason why this index has not gone anywhere is the fact that the Chinese have built 30% of the value of silver, not silver, but just a minute. I'll put the chart up here so you can take a look at it. The reason why the Dry Baltic Index is so low is the fact that over the past several years, the Chinese shipbuilders have added 30% more tankers and stuff like that. Well, if that's the case, you would think that the economy in China would have been a lot stronger. I mean, I know it's not based on ships, but that would be one area that you would be wondering about. The second thing that that I always talk about is the VIX index, and that is just, I mean, people have just written it off. It's no good anymore from what they say. It keeps going down and down and down. But over a long time frame, that volatility index has been a pretty good indicator of what happened, to people that get overly complacent, and that's what's happening in the stock market now. Is that there's just no one that has any fear at all. I mean, there's zero fear. And compared to you look at the VIX index, what it was, back in 2008, you had an index that everybody was absolutely scared to death of. But whether that's going to remain to be seen, I'm not sure. Now I know we got a break coming up, but I wanted to put in one more time the long-term chart on the Treasury bonds, because we are still up in this zone here where we could get one more jab up to complete this final butterfly pattern that we've looked at. This goes back 30 years. We've been in a period of falling interest rates for 30 years, and I believe that cycle, based on this pattern, is getting ready to turn around. There's only a few people that are on the same bandwagon that I'm on, the bandwagon with the one shaky leg. But that's what it looks like. The pattern is there. I'm waiting for the final confirmation, either one more jab up or move below 143. The question is, what is the Fed going to do if interest rates start to rise? Because they've used so many tools to keep interest rates low, they're going to have a real difficult time, to try to control it, if in fact that is going to be the case. Much like what happened with the inflation, when Greenspan was, overinflating, during the 87 through 90, well, to the 2002 level. They just kept pumping money into the thing and, giving credit to everyone, and that led to the fall in the housing market and stuff like that. But how is this will be corrected, I don't know. But we've got too much debt out there, and what we're trying to do is how to, work our way through it. They're supposedly making some compromises and stuff in Congress, which I think is a good thing to do. But, we have some belt tightening to do longer term. But, whether that'll be done in that matter or not, I'm not sure. I'm going to take a little break here, and then we'll wind up the show. 877-927-6648.
If you're an investor looking for a great weekly investment newsletter, then now is the perfect time to try out Ken Shreve's Ultimate Growth Stocks. Every Tuesday, Ken breaks down multiple sectors in his weekly newsletter, Ultimate Growth Stocks, with a full in-depth report including specific trading recommendations within his model portfolio, charts, sector analysis, upcoming economic data, along with intra-week trading updates on newsletter positions whenever the market dictates. Right now, you can receive a full month, that's 30 days, to evaluate Ken's newsletter free of charge to see if it fits your trading plan. At less than $75 per month, Ken provides you with his expert trading advice that can pay for itself in no time. Take advantage of this great offer by signing up for a 30-day free trial to Ken Shreve's Ultimate Growth Stocks today. Don't let this offer pass you by. Visit the front page of TFNN.com and sign up now.
with the launch of Tiger TV. TFNN has brought our programming to the next level. With Tiger TV, you can gain access to each host's charts and computer screens as they host their daily stock program. Whether it's Tom O'Brien, Steve Rhodes, Basil Chapman, Ken Shreve, David White, Larry Pesavento, Victor Jones, or Daryl Martin, you can catch all of our technicians hosting their programs live and archived on Tiger TV for your viewing pleasure 24 hours a day, 7 days a week. If you haven't checked out Tiger TV, then visit TFNN.com and see what you're missing.
David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen, live during those shows, and have access to all those charts. You can test drive the Tiger's Den, absolutely free, for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com.
Are you looking for a precision edge in the market? Something that can stack the odds in your favor? Then look into Larry Pesavento's new trading newsletter, Patterns, Profits, and Peace of Mind. In each weekly issue, Larry explains what's going to happen in the markets based on the pattern he sees developing and gives you actionable trade ideas based on those patterns. Plus, you'll get his detailed analysis on a variety of markets and sectors, including stocks, treasury bonds, the gold market, oil, the dollar, the Forex market, and more. And you'll get the Technical Corner segment, which is a short but powerful weekly training session on trading. You'll get access to all the patterns Larry is seeing in the markets, plus the Astro Harmonics and powerful Bradley stock market model that Larry utilizes for less than $5 a day. An extremely potent combination that will give you just the edge you've been looking for. Try Patterns, Profits, and Peace of Mind absolutely free for 2 weeks. Go to TFNN.com and click on the free trial link at the top of the page. That's an $85 value, yours free when you register right now. Get Larry's Patterns, Profits, and Peace of Mind and get the edge you've been looking for.
This segment is brought to you by TFNN. Test drive all the newsletters for free at TFNN.com.
Let me finish.
Now, back to the Futures Hour.
Okay, we're back, folks, and we want to wind up. We've got a full moon tomorrow, and remember, we had some really strong cycles that started last week on the 14th, and I know it's been a pretty rocky 10 days if you've been short a few things. With, of course, if you're short Apple, that's different. But these cycles are very big. Unfortunately, there was a whole bunch of them coming together. The last ones finish up here on tomorrow, which is the full moon. And, of course, it's been, hitting the full moons. But the trouble is that the pullbacks on the full moons or the new moons have only been 2 or 3 days, in the market. So that's all I can say. We've completed all of the ABCD patterns that I can find in the Dow Jones, in the S&P. The NASDAQ has not done anything because of the fact that Apple has kept it down. It's been, quite bearish, all along. It's still trading below the 61% retracement. In fact, it's not down very much today, given the fact that, Apple was down, $50. But remember, these are price-weighted, so as the price of Apple drops, it has less effect, on the NASDAQ. So that's the main thing of looking at it. The other thing that we talked about a few weeks ago when John from the trading room talked about it, and that was the lumber. That lumber had this huge ABCD pattern that it completed, and that was in the midst of a terrible collapse in the market. And it's just been really amazing what's happened to lumber in the past few trading days. When John was talking about selling that, it was trading in the 380 level, and now it is trading at the 356 level, and that's a big move. I'll put that chart in there because it's got a lot of ABCD patterns and some of the swings that we look at that are there that are very important. But it did complete the very large pattern up there and has reversed quite a bit. Whether it's going to continue to reverse or not, I don't know. But it's had a pretty good correction from that big ABCD level. So remember, the trade of the year was being short the S&P at around 1480, 1482, wherever you got the order off, and the stop is at 1507, and so you keep that working no matter what day it is. That's all there is. That's all you can do. We've been up 9 out of 10 days in the Dow Jones. That makes it an outlier event, coming into a full moon. And if I wasn't short already, I would be. So anyway, that's what I see for right now. The gold needs to hold those support levels that we talked about. That's very, very important. And also the bonds. The bonds are very important to hold that 143. If the bonds break 143, we'll probably be in a 2000 type run up in stocks. Where they go, I don't know. But when stocks leave gaps like they have in the Nasdaq, not in the Nasdaq, but in the Dow Jones Transportations and the Dow Jones Industrials and things like that, and the S&P, you have to respect that. That's one of the things you want to always do is don't stand in front of the freight train. So it's okay to stand in front of the freight train, but have a stop there that'll blow you off the tracks before the train gets there. And that's the real key is to be able to get in there and play again. When you do take your loss. So just remember that we've got some key levels that we're looking at here. So live every day in an attitude of gratitude, and may God bless.
Let me tell you something, folks. I have people coming up to me saying, I just can't believe the amount of work that Steve does on his newsletter. And I says, I absolutely agree.
That is a recent clip from the Money Masters show that Tom and I do each day at TFNN. My newsletter service, Mastering Probability, is much, much more than a newsletter. Yes, it's outperformed the S&P 500 by 100% during the last 15 months. But more importantly, it's an extraordinary education, a roadmap for your success. And it's yours risk-free for the next 30 days. Just go to the homepage of TFNN.com and click on my name, Steve Rhodes, and then Mastering Probability, because everyone needs a success strategy. For most, it's a competitive edge, the will to win, the drive to overcome any obstacle. Whatever you call it, winners find a way. Find your way to Mastering Probability today, because your journey to extraordinary rewards is just one click away.